Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, October 6th, and I'm recording this from our studio in Purchase, New York. Kicking off October with a U.S. government shutdown apparently did little to shake investors' confidence. To the contrary, the S&P 500 and the NASDAQ Composite set records again, and the price-to-earnings multiple expanded to 23 times forward earnings. Such is the power of the bull market narrative. On top of the AI CapEx boom, Fed rate cuts and stimulus from the new tax law, there's another theme that has woven into the narrative: an increasing conviction that the economy will reaccelerate and broaden out in 2026, supporting higher earnings growth. We see this view reflected in cyclical stocks materially outperforming defensive ones and the resurgence of small-cap stocks over the third quarter. Currently, the consensus forecast calls for the S&P 500 earnings to reach $302 to $305 per share next year, and that implies an acceleration in profit growth from roughly 9% now to the 13 to 14% range in 2026. This forecast is very ambitious, and it depends heavily on a constructive macroeconomic backdrop. Right now, we think the signals from the economy, however, are mixed. First, consider how we should decode recent messages on economic growth. While second quarter real GDP growth was revised much higher to 3.8%, and some metrics point to momentum in consumption and corporate CapEx, several other indicators are far less positive and do not suggest economic broadening. For example, the September ISM Manufacturing Index came in at 49.1. Marking the seventh month of contraction, and the data showed new orders losing momentum. Echoing this weakness, fund distributions in private equity continue to be disappointing, suggesting that underlying companies are facing genuine economic pressure. Taking this trend even further, based on national income accounts for businesses, profit margins at companies overall are actually down year to date. The labor market is also sending mixed messages. On the positive side, new unemployment claims have stabilized and the overall unemployment rate has barely budged. But labor markets seem to be weakening on the margin. A recent Conference Board survey indicated that jobs are becoming more difficult to get, and last week's payroll numbers from ADP were actually very poor, showing that private sector jobs declined by 32,000 in September, and a disproportionate share of that decline came from small and medium-sized businesses. Finally, a hoped-for rebound in the housing sector is also in question. Homebuilding stocks have rallied as much as 45% since April, but an influx of new multifamily housing is expected in the coming months, creating rental competition for new homes. It's unclear whether mortgage rates and overall home affordability can improve enough to offset these headwinds. In sum, there are increasing signs from the U.S. economy that the dreams currently being priced into markets, an extended AI CapEx boom, more stimulus, and a jump in profit growth may not all come true. Given stretched equity valuations and the lack of appealing risk premiums, we're inclined to rebalance portfolios with slightly more defensive tilt. Consider adding to healthcare stocks and swapping some lower quality credit for intermediate duration U.S. Treasuries. We can also add real assets, including gold and other precious metals. We also suggest continuing to build passive exposure in emerging markets, which are apt to rally on declining U.S. yields and a weaker U.S. dollar if U.S. growth falters. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.